This is The Bottom Line. The Bottom Line on 938 Live.
Sluggish, struggling and stagnant. That's how economists have branded the Eurozone economy this year. The downbeat assessments came as the bloc of 18 countries saw persistently low inflation coupled with meagre growth in the second and third quarter. 938 Live's year-ender series on The Bottom Line, Travis Teo reports.
The Eurozone economy might have emerged from a recession last year, but is still looking pretty gloomy. As recently as last month, British Prime Minister David Cameron wrote in The Guardian newspaper that the Eurozone is teetering on the brink of a possible third recession, with high unemployment, falling growth, and a real risk of falling prices. While Chief Economist at Bank of Singapore Richard Jerram isn't that pessimistic, there are still areas of concern.
Well, the Eurozone economy has been struggling throughout 2014. It started off reasonably brightly, but there's certainly been a slowdown in growth over the last 6 months or so. It does look as if that's leveling off. It looks as if they will avoid recession, but certainly the growth is substandard, probably below 1% this year.
Jennifer McKeon, senior European economist at Capital Economics, describes growth in the Eurozone as sluggish.
There are various reasons behind it. So for the peripheral countries, it still relates partly to debt. Government debt levels are still very high. There's continuing, albeit easing, austerity, and also households and some firms are still trying to deleverage. So there's limited scope for strong domestic spending in most of those economies. There is scope for stronger domestic spending in Germany, and indeed consumer spending has picked up. But at the same time, exports have weakened a bit. That might relate partly to geopolitical tensions and also just to generally weak demand from emerging Europe.
Earlier in September, the annual inflation rate in the Eurozone hit a 5-year low of 0.3%. Moving forward, the European Central Bank expects inflation to remain well below their target rate of 2%. In fact, Capital Economics Ms. McKeon says momentary deflation is possible.
There's a real risk that inflation dips into negative territory at some point in the coming months. It's already very close to zero, and core inflation has actually fallen to a joint record low of 0.7%. So I think it's pretty clear that underlying price pressures are non-existent. Looking ahead, there are some factors that might start to pull it up a bit. There have been some signs of modest improvement in the labour market, for example. Of course, if the oil price continues to fall, there's a real downside risk to the headline rate.
To counter benign inflation, Bank of Singapore's Mr. Jerram says government bond purchases might help.
Well, the European Central Bank might go for bond purchases. I mean, they've certainly already said that they want to expand their balance sheet by about 1 trillion euros, and it's going to be quite difficult to have that type of expansion unless they do buy government debt. But we can see that some actors in Europe, especially the Germans, are still quite opposed to buying government debt. They think that that will reduce fiscal discipline, and that will lead to all sorts of problems in the future. So I think there's quite a struggle going on at the moment about whether they actually will or won't start buying government debt in the same way that Japan and America have done in recent years.
Observers are expecting the Eurozone economy to grow by a marginal 0.8% this year and a faster pace of 1.3% next year. The Bottom Line is brought to you by Turkish Airlines, Europe's best airline.